When the machinery behind the world's most powerful currency cracks under pressure, the friction is felt first in the stock market, the financial system's core. This system is built on a single atomic unit, the stock. To hold a share is to own a literal, fractional piece of a business, giving the investor a direct stake in its future success or failure. Ownership is structured by specific rights. Common stock allows for a claim on profits and a vote on major corporate decisions. Preferred stock, however, swaps those voting rights for a higher priority. These shareholders are the first to receive steady dividends and the first to be paid if the company is liquidated. These units are traded in massive, centralized marketplaces. The New York Stock Exchange stands as the primary battlefield, where brokers and electronic systems negotiate the value of American industry in real time. The speed of these negotiations depends on volume and liquidity. Volume tracks exactly how many shares are moving, while liquidity determines how easily a position can be bought or sold without a lack of buyers forcing a collapse in the price. These basic metrics, structure, volume, and liquidity, provide the first clear look at the invisible forces dictating the movement of global wealth. Investors weigh the power of a corporation by calculating its market capitalization. This total value is found by multiplying the current stock price by the number of shares held by the public. Market cap alone is often a hollow number. For a fuller picture, analysts look at enterprise value, which accounts for the cash a company has on hand and the mountain of debt it carries on its balance sheet. After all expenses are paid, the remaining profit, or net income, is divided by the available shares to find the earnings per share. This EPS figure shows exactly how much raw profit a company generates for every single unit of ownership in existence. By comparing the stock price to those earnings, we get the PE ratio. This yardstick tells the market if a company is trading at a fair value based on its profits, or if the price is inflating dangerously beyond what the business actually earns. Companies that maintain strong earnings and stable growth through decades of market cycles are known as blue-chip stocks. Established giants like Apple or Johnson & Johnson serve as the reliable anchors of the U.S. economy. These mathematical ratios provide the structural framework for the market, allowing capital to flow toward stability and away from failing enterprises. To manage risk, Wall Street groups individual stocks into diversified vehicles. Mutual funds pool capital from many investors to buy a managed mix of assets, while exchange-traded funds, or ETFs, track entire sectors and trade with the speed of a single share. While retail funds focus on long-term growth, hedge funds use more aggressive tactics. These private pools of capital utilize heavy leverage and short selling, betting that prices will fall, to generate high returns in any market condition. The health of these vehicles is tracked by major indexes. The S&P 500 measures the largest 500 companies in the U.S., while the NASDAQ focuses on the tech sector, acting as a real-time scoreboard for the broader economy. Logic is often pushed aside by market sentiment. Collective optimism drives a sustained bull market, pushing prices upward until speculation creates a bubble where prices rise far above actual value. Investors track this rising anxiety through the VIX, often called the Fear Index. It measures expected volatility over the next 30 days. When the VIX spikes, it indicates that traders are bracing for sudden, violent swings. When fear becomes systemic, bubbles burst. The result is a sudden market crash that can wipe out years of growth in days, leading to a bear market where falling prices and pessimism dominate the landscape. Once institutional panic reaches a ticking point, the financial damage spreads. The loss of capital on Wall Street begins to restrict the actual physical economy of the United States. A severe market collapse can trigger a recession. Economists define this as a period where a nation's gross domestic product shrinks for several consecutive months, leading to lower corporate earnings and rising unemployment. Parallel to this is inflation, a steady rise in prices that erodes purchasing power. Over time, inflation devalues the currency, making every dollar held by an investor or consumer worth less than it was before. Deflation presents the opposite risk. As prices fall, consumers delay purchases in anticipation of even lower costs, which causes business production to stall and can lead to a spiral of economic stagnation. The most difficult scenario to manage is stagflation.
Here, prices rise sharply even as economic growth stops and unemployment remains high, creating a trap that the market cannot easily escape on its own. These macroeconomic failures represent a breakdown of the free market cycle, requiring intervention from authorities with the power to manipulate the value of the dollar itself. When systemic collapse threatens the nation, the final layer of financial power is activated: the federal government and the central banks. The government uses fiscal policy to stimulate the economy. By increasing public spending or cutting taxes, they attempt to force capital back into circulation and prevent a deepening recession. The Federal Reserve manages monetary policy. They control the total money supply and the cost of borrowing by setting interest rates, tools used to either cool down inflation or inject liquidity into a frozen market. These mechanics, from the individual share of stock to the interest rate decisions in Washington, form the foundation of the American financial system. Understanding them reveals how a nation manages its wealth and maintains its influence over global trade. To see more of the logic behind the dollar and how these systems impact your world, like this video and subscribe to Dollar Logic USA. The stock market looks like chaos from the outside, but underneath the ticker tape, it is a mechanical engine running on specific rules. The fuel for this engine comes down to two base units of corporate ownership. If you buy common stock, you get a slice of the company's profits and a vote on big decisions. If you hold preferred stock, you trade away your voting rights for a guaranteed spot at the front when cash dividends are paid out. Holding a stock means you own a literal piece of a business. To navigate how that wealth aggregates and moves across the globe, you have to learn the terminology of the people operating the machine. That movement happens at a stock exchange. The New York Stock Exchange acts as the primary physical and digital hub where buyers and sellers execute trades. Investors connect to this hub through a brokerage. When optimism is high and prices steadily rise, we enter a bull market. During these periods, share volume spikes, creating high liquidity, meaning you can instantly buy or sell without crashing the stock's price. Companies enter this public arena through an initial public offering, or IPO. From there, everyday investors acquire these shares to build a portfolio. Instead of risking their capital on single companies, they bundle dozens of assets together using mutual funds and exchange-traded funds to spot out the risk. This animation shows how we track that massive web of assets. We use an index. By grouping hundreds of companies together, like the S&P 500 does for the largest US firms, investors establish a single clear benchmark to measure the health of the entire ecosystem. The entire system relies on forward momentum. But trusting momentum is dangerous if you lack the tools to measure the underlying reality of what you are actually buying. How do institutional investors separate a company's actual worth from market hype? They run fundamental analysis. The baseline calculation is market capitalization, simply multiplying the current stock price by the total number of shares. To calculate what it realistically costs to buy the entire business, analysts look at enterprise value. This metric strips away the cash the company holds and factors in the raw debt they owe. Gross revenue enters the top. Subtract expenses to get net income. Divide profit by shares for earnings per share. Compare EPS against the stock price, the PE ratio, to reveal if a stock is wildly overpriced compared to its cash. Factoring in expected expansion gives us the PEG ratio. This helps analysts distinguish a highly speculative growth stock from a cheap value stock, or a stable blue-chip stock backed by a massive corporation. These calculations serve to completely anchor the market. When the public ignores the math and bids up prices purely out of greed, the valuations detach entirely from the physical business operations. This chart visualizes a market bubble. The flat line is a company's free cash flow, the money left over after paying its expenses. The vertical spike shows the asset price completely abandoning that foundation, driven entirely by hype. When the gap between hype and reality stretches to the breaking point, insiders watch the VIX. Often called the fear index, this tool tracks expected market volatility. When it spikes, traders are actively preparing for violent downward swings. The pressure usually releases through a correction. This is a sudden 10% drop from recent highs that serves as the initial trigger for institutional panic. If the selling accelerates, the trend spirals into a bear market. Heavy pessimism dominates the exchanges, driving long-term asset values down over a sustained period. On the extreme end, panic and forced liquidations trigger a crash. A sudden, massive collapse in stock prices wipes out years of gains in a matter of days. A crash actively destroys the underlying capital that funds daily business operations, corporate payrolls, and retirement accounts. The financial damage rapidly leaks from Wall Street into the physical economy, creating widespread systemic risk. When corporate earnings stall, companies stop hiring, and the total gross domestic product shrinks for several consecutive months, the overall economy enters a recession. Recessions threaten the currency. Inflation occurs when the cost of goods rises, eroding your purchasing power. Deflation operates in reverse, causing prices to drop, which paralyzes consumer spending and severely slows economic growth. The worst possible outcome for an economy is stagflation. This is a rare, crippling environment where prices skyrocket, but economic growth flatlines and unemployment remains stubbornly high. To manage these crises, central banks intervene. In the US, the Federal Reserve exerts absolute control over monetary policy. By manipulating interest rates and adjusting the money supply, they dictate the cost of borrowing for the entire country. Meanwhile, the government executes fiscal policy. They wield taxation and raw government spending to forcefully stimulate a lagging economy or cool down an overheated one. These top-down interventions alter the baseline rules of finance. Investors who fail to recognize shifting policies lose their capital, while those who adapt protect it. Look at this diagram. It shows the defensive perimeter built through asset allocation, dividing capital across stocks, bonds, and commodities. By pairing this structure with passive investing and using dollar-cost averaging to automatically invest a fixed amount every month, you systematically shield against market volatility. To measure if this defense is mathematically sound, analysts use the Sharpe ratio. It calculates exactly how much return you generate for every single unit of risk you take on. The stock market heavily rewards precise calculation and punishes blind speculation. Understanding the specific terminology of finance gives you the clarity to see exactly how global wealth is structured. If you want to continue uncovering the hidden logic behind the numbers, like this video and subscribe to Dollar Logic USA.